was folks really don't understand what it takes to own a home as far as the costs are concerned. So that is the purpose of this video. I'm going to go over a $300,000 loan scenario that I just went over with one of my clients, and hopefully this will give you a better picture when you do get ready to get on the property ladder. So the first thing I wanted to address is, let's get this out of the way. Okay, the income. So this client that I'm speaking about, they make $115,000 a year. Okay, decent money. But what a lot of us don't realize is if you're a W-2 employee, and I'm making the assumption here that there's no other credits like child credits or anything of that nature. I'm just looking at an estimate of what the federal tax burden would be for someone making $115,000 in the state of Texas. And so the estimated taxes that one would have to pay, again, not knowing the full tax picture, if there's any credits or anything of that nature, but the tax burden is $18,328. Okay. And so if you look, this is what is this? Talent.com is the calculator that I'm using. And here, let me blow this up. There you go. Calculator.com. You could go there yourself. But as you can see, put the salary of 115 in. And so when you get the Medicare, the Social Security, Medicaid, Medicare, or FICA, Social Security, federal tax, right? The total tax is about $27,125. And so the net income that this person would have in this estimate is $87,875. So keep that in mind when we go through this scenario. So the reason I wanted to pull that out is because we in the mortgage lending industry or lending money, we go off of the gross income, this 115, but you actually live on the net, this 87,875. And all of the ratios that you hear out here are based upon gross income in most cases. Okay. So now with that in mind, let's go a little deeper. And I did a loan comparison. And on this loan comparison, I'm really just showing it's a FHA 30-year fix based upon rates today for my company, for me, 6.25%, no discount points. This is just a par rate, lowest rate that I could get. And the APR is 7.117. APR is the cost of your credit as an annual term, the monies that you would actually pay for getting the loan, not all of your closing costs. I digress. But the interest rate is at 6.25%. Okay. Upfront funding fee is $5,066. So when you take the 3.5%, which is $10,005, less the sales price, $289,500, most people finance the upfront MIP, mortgage insurance protection. That's $5,066. So the total loan amount is $294,566. And then the estimated monthly principal and interest payment is $1945.67. Okay. So wanted to get those variables out because that's what we're working with. As we come back to the example, you can see the principal and interest portion of the payment is $1945.67. For those of you that don't know, if you're getting a fixed interest rate loan, this is the portion of the payment that won't change as long as you don't refinance. So if you get a 15-year, it's fixed. That principal and interest is fixed for 15 years. I'll go 10, 15, 20, 25, 30, whatever that interval is, that principal and interest payment does not change. What a lot of people are lamenting about and not understanding is that the taxes and the insurance, as well as your homeowner association could change, all right, from a year-to-year basis. But for this exercise, this home is in a tax rate of 2%. And so the estimated monthly tax is $400, insurance $175, new home. Might be a little high, but we'll go $175. Homeowner association fee is $50 a month. Okay. So when we add up the principal, interest, taxes, and insurance, along with the HOA, although you're not going to pay the HOA with your monthly payment, that's going to be a separate bill that your homeowner association sends out to you at whatever interval that they collect. Could be quarterly, could be monthly, could be semi-annual, could be annually. That aside, we as the lender are going to qualify you with that payment because that's a liability that you have. And we're going to use the number of the annual number divided by 12 at the time that you close. Okay. So that gives you an estimated principal, interest, tax, insurance payment of $26,257. Pity payment. Okay. Now, doesn't sound bad. These folks make money. They can afford it. But this is what I want you to pay attention to. What I call your maximum ratios, if you will, when you look from a gross income standpoint. Okay, when I take the pity payment and divide that into the gross income, they're at a 27%. So 27% of their income is going towards that house payment. And that's a good thing, right? If that was really the number, 27%. And again, we're going to qualify you off of the gross. But in all actuality, it's really 35% of their income because they're living on the net. So I think I'm going to title this video, Don't Let Your Gross Income Get You in Trouble. Because you don't live on gross, you live on net. Why? Because we have taxes. Okay. Everybody has taxes, even if you don't see them coming out. When you look at the description on your pay stub, that's what all those things are. Hopefully it works out to where you don't have to pay more, but there it is. So now, hopefully that makes sense. I'm going to scroll up a little bit because I also want you to understand that these folks have monthly obligations, monthly minimum payments that have to be allocated for us to qualify. And so those run about $1,100 a month. This is just as an aside, this is another area that folks aren't thinking about when you're trying to buy a home, because you're just thinking about that gross income. I want you to think about your net income because that's what you live on, as well as those monthly obligations when we look at it from a standpoint of your total back end ratio, your total debt to income ratio, how much of your income is allocated towards the buying and maintaining of this home. Okay. So there's $1,100 there. A big gotcha that I'm seeing with a lot of folks now are car payments. These car payments are crazy high. And then I always recommend that my clients have enough income to be able to put away every month 14 cents per or times the square footage of the home. And this is for the repairs and maintenance that might come up. I'm not going to say beautification and the other things that you do for the home, but the systems, right? Your roof, your HVAC, water, septic, if you have it, your structure, your outside, your brick, your hardy plank, the framing, and then your electrical panels. Okay. That's what this amount is. So 14 cents times 2,500 square feet. That's the square footage of the home. And because it's new, I'm real comfortable with that. And so that $350, that's what this equates to, is something that I show my clients. Now, you guys do what you want to do. My job really is to help you see things, in my opinion, that you don't see. That's what a good loan officer does, and present you with these things to get you to make sure you really understand as much as possible what's going on. And again, I believe that's where the big disconnect has been, because all people are telling you about is your monthly payment, and they're not really telling you about your full payment. They're really talking about the principal and interest portion. Okay. So now when we look at these things, okay, really, let's do the math here. I'm going to do it live. So if we have $1,100 in monthly obligations, bills that we're already paying, plus 26, I'm going to just round up 21. And then we're saying we're going to add another $350 a month for the upkeep of the home, regardless if it happens or not. We're just going to be disciplined to do that. So that's $4,072. Okay. So if I multiply that times 12, that's $48,864 a year out of that income. And I divide that by 115. So now we're at 42%. I did the math down here. I just got it lower. So we're at 42% of your total gross income. But when you look at adding all these numbers up along with the maintenance, you're actually at 55%. Okay. You're at 55% of your net take home income. So if I said 87,875 times 0.55, divide that by 12. Yeah. So you're at 55%. So you have to be able to make sure you're comfortable with these numbers. And again, I believe this is where folks are not being educated, because growth wise and folks that are just selling you houses, again, I'm in the business, but we need you to understand so that we don't have all of this doom and gloom out here and people understand what it is that they're doing. If you're not able to do that, then you really should think about it. And this is why. You got to always think about your exit strategy whenever you do sell the home. Curb appeal, maintaining the home. People nowadays, it blows my mind, they want the top dollar and they've rolled the home down and not taking care of it at all. You're not going to get top dollar. You didn't maintain your investment. You see what I'm saying? So before you go into a home, you have to understand these things. Now, guess what? When I got into my first home, I didn't know any of these things. That's why I'm wanting to explain them to you, because this is really what the education is about, for you to understand. Now, you can do what you want to do. This is years of experience trying to help people see what's happening. And I strongly advise that you don't get into a home feeling like, thinking you can, anticipating future revenue streams. Don't do it. What my recommendation was for this person, after looking at the actual ratios and their numbers, hey, we need to come down in purchase price. Well, a lot of folks are stuck on brand new. And don't get me wrong, brand new is what you want to do, especially your first time, I understand. But you have to make sure you can afford it. And it's not just making the monthly payment, it's maintaining the property so that you can get the most out of it when you move up the property ladder. Okay? And you want to be comfortable. You want to be able to continue to live. And you want to be able to have the margin to continue to invest in or diversify in other places, or whatever it is that you want to do. So again, this $350 should take care of the roof, the HVAC, the water, the septic, the structure, and the electric panel, especially after the first year. Now, after your first year, you could go granular. You could look at your utilities and things of that nature, because you've been there for that period of time, and you might need to add a little more or maybe subtract a little bit, but you never need to go below 14 cents per square foot. And we may even have to bump that up a little bit just due to all the tariffs and inflation that's going on, right? But this is a good baseline, and no one that has implemented this has ever gotten back with me and cursed me out. They've not, because it's being proactive and not reactive. Now, before I get out of here, here's the deal. I think you should get an account that's not easily accessible. All right. And you can, with all of the automation that we have now, you can automate that money out of your check stub and have it every month put into that household account. Worst case scenario is this: nothing ever goes on at the house that you're in. Say it's your first house, you move up. Not only do you have that equity because you were able to tap into these funds that you've allocated for to do the deferred, to keep the house, the curb appeal, and all those things looking good. And then you have an additional amount of money either to, buy your furniture and things of that nature, or put it in as a down payment and the principal reduction on the next house when you move up. Lastly, segue into your 6 months worth of expenses. After you've been in this house a year, you should have a good feel of what the lights, water, gas, and then you can start being more proactive and maybe putting some more monies to the side and tweaking these numbers a little bit, because again, guys, it's your money. It's called delayed gratification. So my time is up. I thank you for yours. As I always say, guys, let's be good to one another. Let grace abound. And if you like videos like this, let me know in the comment section. And till the next time, indeed.